All right, hello and welcome to Omega Wealth Management's 2020 Investment Review and Outlook. My name is Jared Jones. I'm an Associate Financial Advisor and Director of Investments at Omega Wealth Management. And today we'll be talking a little bit about what happened in 2019, some things we're looking at, and then also what's on the horizon for the 2020 and the year ahead. What are some things investors should be paying attention to and expecting as we move into the new year? So as we look at performance by index here on this slide, we can see where things wrapped up 2019. The Dow Jones Industrial Average, which looks at the largest 30 United States stocks, large cap stocks, so the 30 largest companies by market cap, that index returned 23.34%. The S&P 500, which looks at the top 500 companies, also considered large cap stock index, returned 28.80%. Russell 2000, which looks at small cap stocks in the United States, returned 23.72, and the MSCI Europe, Australia, Far East Index, which looks at international developed markets, returned 22.01%. And last, Barclays Global Aggregate Bond Index returned 8.72. That looks at intermediate term bonds. So all in all, we see 2019 had a great year for financial markets. Everything from bonds to large, small, international, all positive on the year. And that really plays out in the next slide that we'll look at, which is an asset class return quilt. So this looks at all major asset classes, if you will, going back to 2005. And what we see in 2019 is that all asset classes were positive. Cash was the worst performing asset class, but it returned 2.2%, which is not a bad thing because inflation was at 1.8%. So whenever cash is outpacing inflation, that's always a welcome sign. That means the money that you have on the sidelines should be working for you a little bit harder than inflation, and we'll take that every time we get that. The other thing I noticed from 2019 is all asset classes were positive. That doesn't happen every year. It has happened in the past 15 years, but it's always nice when you can say, however you were invested, you likely had a good return on your portfolio. Some of the more growth-oriented portfolios where you're more equity-oriented saw double-digit returns for the year. So that's always great. We do understand there are years like 2008 when a recession comes where that isn't always likely. So we'll take years like 2019 when we can get them. Large cap stocks returned the highest amount for asset classes at 31.5%. And the last I'll just point out, when I look at this graph, all I see is the randomness or what appears to be random asset class returns from year to year. There's really no telling which asset class will perform the best, which one will perform the worst from year to year. So we look at the asset allocation box here, which is tracked by this black line. If you can see my mouse, I'm trying to point it out. This looks at a well-balanced portfolio, around 60% in equities and 40% in fixed income. And what it shows you is what you get out of diversification. You're never going to be the top of the pile with diversification, but you're also never going to be at the bottom of the pile. So this is one thing we like to track. What is a good return from year to year based on a diversified portfolio? Next on this slide, we have the S&P 500 intra-year declines, and that's shown by the red dot at the bottom of the bars, and you can see where the market finished for the year. So in 2019, we finished positive at 29% for the S&P 500, but we know it wasn't all straight up. There were bits of volatility throughout the year. If you think back to the second and third quarters, we did see a bunch of volatility. And at one point in the year, we had a 7% decline peak to trough. So it wasn't all straight up like it kind of was in 2017, if you can think back to there. On this chart here, it says the largest decline peak to trough for that year was -3%. So a little bit more than 2017, but largely it was a great year. We saw a lot of growth in our portfolios, and that was great. You know, one thing that this graph also points out is that if you think about market shorthands, we often hear that the market's up 3 out of 4 years. And that's exactly what happened in the S&P 500 over the last 40 years. 30 of the 40 years shown here, going back to 1980, were positive. So we can say that that is indeed true over the last 40 years, that 3 out of 4 times the market has been positive. So that's something to keep in mind. Next, we're going to talk a little bit about where the market is valued. Is it expensive? Is it cheap? Is now a good buying point? Is it a good selling point? And one way we look at that is the price to earnings ratio, also called the PE ratio, is a ratio used by financial analysts to value a company that looks at the current share price, what the stock or company is trading at, versus its earnings per share or per share earnings. We can also hear it referred to as a price multiple or an earnings multiple. And again, what it's used for is by investors and analysts to determine the relative value of a company. It looks at an apples to apple comparison. So if I want to buy two of the same kind of stocks, we'll look at the PE ratio to see which one might be a better value. Another thing it can be used for is to compare a company against its own historical record, or compare an aggregate market against its historical record over time. So that's what we're going to look at on the next slide. We're going to look at the S&P 500 going back to 1995. We can see the average PE ratio, the average forward PE ratio for the S&P 500 over that time is 16.28. And currently, the market finished, or the S&P 500 finished the 2019 year with an 18.18 forward PE ratio. So thinking about what all that means is we're slightly above the 25-year average, but we're not outside of a standard deviation. It looks like we have a little bit more room to go before we're outside, which would be a big red flag for investors. The last time we went outside one standard deviation was back in the dot-com bubble, the run up there starting in 1999 to 2000, 2001. That really shows, if you look there at 24 times earnings, that shows what an elevated PE ratio looks like. That's always cause for concern. So while we are above the average at above the 25-year average, we're not to the point of concern like we were back in 2000, 2001. So that's also something to keep in mind as we move, and we hear a lot from financial experts about how highly valued this market is. Looking at it by style, we can see we'll focus mainly on the difference between value and growth stocks for the year, and looking at large and small companies. So value is looking at companies that have been around for a long time, usually the dividend paying stocks, whereas growth are the new kids on the block, if you will. Those are the FANG stocks that we hear so much about. You know, the Facebooks, the Amazons, the Apples, the Googles of the world. Throw Microsoft in there. And you can see over the past year, growth beat value pretty significantly, looking at both large and small. Large growth was the top performer for the year at 36.4%, and that's all those FANG stocks that we were just talking about. So that's where the return came from, mainly with the large cap stocks. And then looking at value was at 26.5 on the large, 22.4 for the year on small value, and looking at large growth, small growth, we're at 28.5. So this hasn't been anything new. We've seen growth outpace value for really the past decade, since the last recession. And you can see that at the bottom here. Let me see if my mouse will point it out. Since market lows in March 2009, growth has outpaced value pretty significantly here. So what does that mean looking forward as we think about 2020 and beyond? We look at the current PE versus the 20-year average. Thinking back, this is one way the PE ratio is used, is comparing it against its historical information. So you can see here the small growth is really well above its 20-year average PE ratio. And what that shows to us is that right now, small growth is highly overvalued. Conversely, looking at small value, it's actually below its 20-year average PE ratio, so it's a little bit cheaper. And so we can see value as a whole is more close to its 20-year average PE versus growth. So one thing that we'll use this for is that when we look at our clients' 401ks and reallocating those. We'll keep all of this in mind as we make our annual recommendations there. And SEI is already taking all of this information into consideration as they look and design your portfolios. Looking at corporate profits, I think this paints the picture why the U.S. stock market had such a great year in 2019. The U.S. economy as a whole has been humming nicely over the past year or so. And as we look at corporations, profit margins and earnings per share are up close all-time highs. So the U.S. business has never looked better, and the stock market has really reflected that over the past year. Speaking of the market and the economy, let's take a look at where we are in this current bull market. One of the favorite questions that is always asked of us is how much more does this have to run? How much longer will the party go on? So let's look at this. The average U.S. expansion here is 48 months, and this current expansion at 126 months long is well past that point. So we're at the point where this is the longest economic expansion in U.S. history. But as we compare that to other expansions over the previous century or so, we'll see that this light blue line at the bottom here, that is the current expansion that we're in. So it's been a slower, longer pace, slow, drawn out expansion, maybe that we haven't seen the likes of in a long time. It took close to 16 quarters before GDP turned positive for this expansion. If you compare that to some of the other long expansions, you'll see here this blue line is a rocket shot out of the cannon. I think that's of the 60s. This red one is the 90s. So you can see, I think this paints a picture of why this bull market has gone on for so long. And there's a multitude of reasons why. But as we think about how much longer this bull market has, the answer is we don't really know. It's something that we haven't seen before. So we're going to pay attention to how does this long, drawn out, steady, slow growth, how much longer does this have to run? As we look at the U.S. consumer here, let's see how they shape up as we're heading into the later cycle of what we think is this bull market. Right now, we hear a lot about in the media, especially the financial media, about the 16.4 trillion in total liabilities that the U.S. consumer has, and that sounds like a big number on its own. But if you compare it to the assets that consumers have accumulated in this expansion, it's not that alarming. Total assets for consumers is topping out at 130.2 trillion. And if we look back to where that was heading into the last recession, the last peak was 85.6 trillion in 2007. As we look at household debt service ratio, which is debt payments as a percentage of disposable personal income, we see that looking over the past 40 years, we're at an all-time low on that number, which is a great thing. Heading into the last recession, we were at 13.2%. So really, what that says is consumers are spending less on debt than they have been really in the past 40 years, which I think is a really positive takeaway. You might conclude that the U.S. consumer is well positioned for whatever happens next, whether it's more of this expansion or we head into recession. It appears that the consumer is positioned well. You can also see that household net worth has increased over the past 30 or so years, and we're at an all-time high for the average household net worth. Keep in mind that is an average. It is skewed by some of the larger net worths that have been building up, so keep that in mind with everything. One of the wild cards as we think about 2020 is what the Fed will do with interest rates. This graph looks at what interest rates have done since 1999, and it also shows what the Fed is projecting to do with interest rates. So the Fed's projections is there in blue. You can see that over the next year, they're projecting to hold rates steady, no increases or decreases. And then we'll see some slight increases in 2021. In 2022, go up above 2% again. And the long run projection by the Fed is 2.5%. If we compare that to what the market expects the Fed will do, and this is done by looking at what the futures trading market is trading interest rates at, you can see that the market actually believes the Fed will lower rates in 2020 down to around 1.37, and then no major increases or decreases over the preceding 2 years after this year. And when we look at who's right most of the time, whether it's the Fed's projections, the market projections, most times over the past couple of years, the market has actually been more accurate than the Fed. So this is something we'll want to pay attention to. A lot of talk has been made about what the Fed did with interest rates last year. There's some concern around if the Fed dropping interest rates last year kind of extended or prolonged this expansion beyond what it was supposed to be. Is the Fed, by taking a dovish stance, increasing a bubble or anything like that? To be determined on all of that. One argument would be, if you look at the yield curve, thinking back to the second and third quarter last year, we saw a yield curve inversion, which is the first time we've seen one of those in a long, long time. The Fed lowered interest rates and we're no longer inverted on the yield curve. So there are some arguments to be made for both sides. As we look at consumer confidence, I think 2020 is going to be a huge year for the markets in terms of their political beliefs. So something that's not new to any of us is the growing divide between parties and their views. And I thought this was a really interesting slide. It takes a look at how people rate the economy based on their political beliefs. So we can see that the Republicans or leaning Republicans say that 80% of people feel good or excellent about where the economy is, whereas only 33% of those that lean Democrat or are Democrat do so. And this isn't really anything new. As we look back over the past 20 years, we can see when a Republican was in the White House, Republicans felt the economy was doing well, and vice versa. What is new, I think, is the growing divide. And as we look ahead to 2020, we're not sure who's going to emerge as the Democratic nominee to take on Donald Trump, but that is something that will have an impact on the markets, whether it's a middle of the road candidate or a more progressive candidate. We'll be paying attention to how the market reacts to that as we gain more information. Next, we're going to look at City National Rockdale speedometers. They take a look at all the various things that impact markets and rate them in green, yellow. So green is obviously good, yellow is a neutral stance, and then red is a negative. So most of this is green and yellow right now. You can take a look. Of course, the negatives are the political environment right now and the geopolitical risks that we see. So as we look at what changed from last quarter, the international economic outlook has actually improved in the eyes of City National Rockdale, whereas the equity market valuation has slightly gone down. And we can think back to the PE ratio slides for some of the reason why that has been lowered a little bit. All right, to round things out, this slide comes from SEI, and we're going to look at the outlook for 2020. Their headline here is "No boom, no bust, no bear." So as we look at the good news heading into 2020, the U.S. global economic growth will likely continue in 2020, but more likely at a sluggish pace. It's not going to be the same level of growth we've seen over the past 2 years. It's going to take a more sluggish growth year. SEI anticipates further gains in the stock market and risk assets to be increasing. They're anticipating returns around single mid digits to upper single digits, so anywhere from 5 to 9%. I think that's what that means. And as you think about that in context to your planning, our clients will know that we assume lower rates of return for your planning numbers, anywhere from 4 to 7%. So if we can fit into these mid to upper single digit returns, that would fit nicely into our assumptions. As we look outside of the US to international equities, we think that the international scene might be a better place to invest in 2020. There are lower valuations relative to the US stock market, and the improvement in global growth prospects and an expected weakening US dollar set up nicely for international performance this year. We'll want to keep an eye to see if international equities can beat US equities in 2020. Looking into China, we've seen their economy stabilize a little bit. Of course, all of this was before the coronavirus outbreak. I'm not sure much analysts had that built into their projections for 2020 when they were made. So we'll want to keep an eye on China and the coronavirus. But as we look at the economy as a whole, we saw some stabilizing towards the end of the year and some positive developments from the economy as a whole. And if you think about the U.S. trade relations with China, we saw phase one of the trade deal go into effect in January 15th of 2020. There's no timeline for any other phases, and we're not quite sure what's on the horizon there, but we should see an improving China economy in 2020. And as we talked about earlier in this presentation, value-owned active managers should see a better result in 2020. They're positioned a little bit better from a valuation standpoint. And the other side of the coin, the bad news, valuations for the U.S. market are above previous highs at a time when expected profits growth is no better than that of Europe or Japan, thinking back to the international equities. So that's something to keep an eye on. Monetary policy and the Fed remains one of the wild cards of 2020. So we'll see what happens. You know, a lower interest rate is better for the stocks, but we don't want to have too much growth. We don't want to see any overheating in the markets to the point of euphoria. That's usually what happens in the run up to a recession. So that's one thing we'll be paying attention to. And while we did see improving trade relationships, SEI feels that the relationship between US and China has been damaged for the long term. So that's why that bullet point is there. And next to last, we see Brexit. Brexit is something that's been lost in the headlines as of late with everything else going on. But Brexit has officially started. There's an 11-month unwind process from the UK and the EU. So we'll want to pay attention to the UK to see what happens as they negotiate their official exit out of the EU. And last, 2020, as we said earlier, is a big election year. Presidential politics are sure to be front and center throughout the year. So we'll want to see who emerges as the Democratic nominee to take on Donald Trump, and what will the impacts of all that be from a financial perspective, financial market perspective. All right, so that's everything looking at 2020 that we think investors should be paying attention to. Thank you for tuning in. If you have any questions or feedback, this is something new that we're trying to do a little bit more of a webinar about the investment markets. So we look for your feedback if you have any. All right, thank you.